Here they're lying.
What? Why do they? I've never done that before.
There you go.
Well, okay, that was pretty easy, Ben. Okay.
Yeah, call me anytime.
Okay, take care. Thanks so much, Ben. Bye bye.
Okay, bye.
Boy, the great ones really make you look stupid, don't they?
Just luck.
Okay, you can see it now, huh?
Yes.
Okay, now we're gonna set this thing up. All right, me and you, Lori. Okay,
Okay.
I got to remember to trim out the first few minutes of this.
Yes.
Okay, so double entry framework. Accounting is called the double entry system. Double entry. It means you have to have two accounts in every transaction, and we're going to call it a debit and a credit. Okay, and we'll get to that in a brief second here. Hey, T account. Remember I was just talking up to you?
Yep.
Take a look at a T account. A T account mimics what the general ledger looks like, and you'll see that in a chapter later. A T account is really a piece of scrap paper. It's a way to organize the information when you're not sure what's going on. So when I asked you to write down after eating dinner, you could put after eating dinner under the word debit. Okay, after eating dinner. And then on the other side where it says credit, you can put liabilities, revenue, capital to get us started. Okay.
Okay.
And then above the word debit, put a big plus sign. Above the word credit, put a big plus sign. Now, hopefully that'll be a useful tool for you. Some students like that, and others, they kind of, learn a little bit differently. But what we're saying here is there's the T account. The words debit and credit, Lori, all they mean are left and right. That's all it means at this point, okay? The T account. Debit means left, credit means right, huh? That'll be a question on the test, you hope, huh? Debits and credit, okay? Okay. And DRCR, the abbreviations debit and credit. And you see that the word cash there now, Lori? You're going to have one of these T accounts or general ledger accounts for everything in your chart of accounts. In other words, you start a business, you certainly want to keep track of the cash. So you set that up as a separate account or folder, if you will. And all of the transactions that impact cash go through this account here. You'll have one for cash, you'll have one for every asset, liability, etc. Okay? T account. Every T account, you see what it says there has an increase, decrease side, Lori. Debits and credits don't mean plus and minus. Has nothing to do with plus and minus, increase, decrease, more or less. One isn't better than the other, okay? They just mean left and right to follow the rules. So every T account is going to have a side that increases the balance, and the opposite side will decrease it. Some accounts increase on the debit side, and some increase on the credit side. Debit's always the left, credit's on the right. So if you look at that sentence I gave you, the left side, the debit side, that's the side of the T account that increases your assets, expenses, and drawings, okay? The right side, the credit side, increases those with a credit, okay? Increases those with a credit. Let's take a look at a T account. Whoa, look at that, huh? Here's your general ledger. This mimics the general ledger, which are the books of the company. You heard that expression, I want to see the books. Here is your T account. So let's see what we have here. We have a debit to cash. So the cash went up 2,000 because as you look at your mnemonic there, assets, cash, are increased with a debit, decreased with a credit. So following this along, at the end of the month, we need to balance the T accounts, balance our trial balance. So what do? We just add the two columns up and the high man wins. Okay? The number that's higher is the ending balance. Now, we just said that cash has well, maybe I didn't say this word. Cash has what's called a normal debit balance. That mnemonic I just gave you with those plus, those are the normal balances of those accounts. What that means, Lori, is that's the side of the equation, debit or credit, that increases the account. So at the end of the month, we would expect to see a debit balance in cash. So if you take a look at the T account on the screen here, the debits total 3,500, the credits total 3,100. So we have a balance of $370, and it is a debit balance. And that's what we would expect to see.
So, but that doesn't mean that will always be that way. That's just what you would expect.
We would expect, yes.
Okay.
Yes, exactly right. Now, if if the month end came and you actually did have a minus in cash, there would be something wrong, because you simply cannot have a negative cash balance. It could mean that somebody just simply made a mistake that you need to find and correct. In the worst case world, you found out at the end of the year that your boss, who's been gone for 2 weeks, looted the company, okay? And the other way you have negative cash is if you're floating checks, which I was forced to do a long time, but okay. So, I mean, if you're looking at this, Lori, I mean, we started with $2,000 and then we spent $1,200. So at that point, the balance was $8,000. Then we brought in more money. So that brought the balance to $13,000, et cetera, et cetera. So you feel pretty comfortable with totaling up the balances?
Yeah.
Yeah, I don't think this part is too tough. Describe the effects on specific types of accounts. Now here, what's going to come now are more helpers on the debit and credit, okay? Again, I can't say this enough. Debit just means left, credit means right. Debits may or increase the balance of a specific account. Sometimes the debit is an increase, sometimes it's a decrease. And that's true for the credits. So they're starting us off with assets. Assets have a normal debit balance. And what do we mean by normal debit balance, Lori?
So that's what we would expect to find in that account.
Exactly. And another way to say it, that's the side that increases the balance. Okay, good. Liabilities. Yeah, if you take this course and get through these debits and credits clear, you'll be way ahead when you get to 230. Okay, liability accounts. Well, look at this one now. Here, they're going to be increased with a credit. Increase with a credit. So, like you said, we would expect to see a credit balance at the end of the month here. Look at owner's capital, equity. That too has a credit balance, just like liability accounts. And maybe I can say this. We know our accounting equation is assets equal liabilities plus equity, right? If assets have a debit balance, by definition, liabilities and capital would have to have a normal credit balance, okay? Revenues, credit balance, credit. We love seeing credits on the income statement. Credits. Sales have a normal credit balance, therefore expenses would have the opposite. And there's no way to really get this into students' heads other than you're just going to keep doing some of these problems and think about it until it clicks. You know, you're really only asking for like 6 things to have in your head, but it is very, very counterintuitive because you're used to saying plus, minus, you know, okay? And then we have an account called drawing, which we'll get to. And this one here is a bit of an outlier. It has a debit balance. I won't go into too much detail right now, but that has a debit. A drawing, Lori, this happens in small companies. You know, you're the accounting person in a small company, and your boss comes out and said, Lori, would you please give me a check right now for $300? So of course you're going to give it to him, but you got to know where to
Mhm.
put it, right? And you say to the boss, okay, no problem, boss. How do I code this? What's it for? And the boss will say, well, I'm taking my wife to Las Vegas for a couple of days. As soon as you hear that, you know it's a personal expense and must come out of the company. And that's what drawing is about. And we'll get a little more into that. Okay, can you read all these words over here? Debit, credit, it's pretty clear? Okay.
Yep.
Here's just another look at it. Another look at trying to understand this stuff. Assets equals liabilities plus equity. Assets debit, liabilities credit. Owner's equity has a credit balance. Got the happy fingers. Owner's equity has a credit balance. Revenues have a credit balance. Expenses a debit balance. Here's a good sheet to look at, Lori. I think this might be the best thing. I mean, I like my little mnemonic there, but this is probably, you see these three columns: increase, decrease, normal balance.
Mhm.
You don't have to memorize all three. You just have to memorize one, because then you know the others automatically.
Right.
So if you can remember that assets, expenses, and drawings have debit balances, well, then you know the opposite is true for decrease. Up with a debit, down with a credit.
Mhm.
And the side of the T account that increases the amount is called the normal balance. So maybe just look at the normal balances and get those in your head. It sounds easy at first, but it will be a little confusing when you start
Yeah,
going.
it's a little confusing.
What's that?
It is a little confusing, but I'm figuring it out.
Yeah. This is the real hurdle. This is the big difference between 110 and 230 is that we go into this in rather big detail.
Mhm.
Whereas 230 kind of almost assumes you know this already.
Right.
Okay, so now remember in chapter 2, Lori, we did a whole bunch of transactions on a horizontal grid, keeping the equation in balance. Now we're going to do similar transactions, or maybe even the same ones, how they would look in an accounting general ledger format, okay? So let's use our T accounts. T accounts. Well, this is kind of what they repeated in chapter 2. When you're ready to make a transaction, know what happened, what accounts are affected. Blah, blah. I'm going to skip that for just now, okay? So here we go. Remember Mitch Williams, the guy who opened up that delivery business in chapter 2? Well, he opened up another one. He invested $5,000 in his business. So the first thing they're telling you up here is what happened, what accounts are affected. What happened, what accounts are affected. Well, what happened was he started a business. So what accounts are affected? Well, we know he's putting cash into the business. And since that's his only asset, that's the equity of the company at that point, right, Lori? It's all he has. So are these assets liabilities? Here they are. And you would see this in your general ledger.
Okay.
Cash has gone up with the debit. Owner's equity or capital has gone up with the credit. And the accounting equation is in balance, okay? Make some sense there?
Mm-hmm.
Now he bought an asset for cash. Well, okay. That means that our cash is going to go down, and he brought in some delivery equipment. So these are both assets. So we're going to have a journal entry. And remember, you need two. You need two, one debit, one credit, at least one debit and at least one credit. Well, cash is an asset that's going down, and the equipment is an asset that's going up. So here we go. The cash went down 2,000 and the balance is now 3. And in exchange for the 2,000, he got delivery equipment, scooters or something. and we're still in balance. You jump in anytime I might be going a little too quickly, Lori.
No, you're good.
Okay, now he bought a scooter on account, bought an asset on account. And remember my famous words, when you see on account, it's on account of what?
Nobody has any money.
Right, so you know there's no cash in this transaction, okay? On account means nobody had money. So let's see what happened here. We bought delivery equipment, but we're gonna pay the people later. So that creates a liability. So let's see what we have here. Well, let's see. Here is more delivery equipment. We now have assets totaling 6,800. But look at here. We have a credit to increase accounts payable. And we're still in balance. 6,800 equals 18 plus 50, right?
Mhm.
Payment on account. Now it's a few days later, perhaps in the same month, and Mitch is going to make a payment toward that bill. No, he's not going to pay the whole thing, I guess. So he paid part of a bill. Well, we know cash is going to be involved, and we know accounts payable. So cash is going to go down with a credit, and accounts payable is going to go up or down with the debit, Lori.
Mhm.
What'd you say?
Oh, no, I'm with you.
Accounts payable goes down with a debit. Okay, well, we just introduced delivery, he made a payment on the delivery equipment. Cash goes down with the credit, liabilities go down with the debit. And we're in balance. Delivery fees earned. He made deliveries and he got paid cash. Okay, well, his business is delivering pizzas. So when he delivers something, that's revenue. He calls them delivery fees, but those are sales, revenue. So sales go up with a debit or a credit, Lori.
Sales go, wait, okay, I'm sorry.
Revenues or sales go up with a debit or a credit.
Up with the credit. No, debit.
No, see, that's the confusion everybody's going to run into. Just till it gets in your skull. I'm kind of asking an unfair question at this point. Now it says right here, increase the asset with a debit and increase the revenues with a credit.
Right. Yes.
This is like real basic rules of accounting, and it can drive you nuts when you're trying to learn this stuff, believe me. So we've added a new account now. He now has sales of 2,100, revenues. He's going to call it delivery fees, okay? 2,100. And look at that. He's got his first cash infusion, right? Now the cash balance is 4,500. If the business would, if he stopped the month today, he'd have a profit of 2,100 because I don't see any expenses yet, okay? Now here comes some expenses. We're going to pay the rent. Paid means cash. Paid means cash, huh? And what do we pay? Rent. Rent is an expense. So expenses go up with a debit or a credit. They go up with a debit. Cash goes down with a credit. Rent expense, 1,000. Oops, sorry. You can see that, right, Lori? 1,000 rent expense. And notice the lettering. Those are important. Enables you to keep track of what's going on easier. You know, the auditor might come to you a year later and say, what's this $2,100 about? Wherever it was. What's this $1,000 about? You're not going to remember, and that'll help you find the trail. Okay, paid rent. Here's another expense. We paid the phone bill. The phone bill. The expense goes up with the debit. Cash goes down with the credit. Okay. I wrote a recommendation letter for an old student I hadn't heard from in about 2 years. And I remember when she was in my 110 class and she had so much trouble with this to the point where I was just teasing her the whole semester. And I'm pleased to see that she's majoring in accounting and transferring to San Jose State. So that makes me feel better, right? Good for her. Delivery revenues earned on account, no money on account of everybody was broke. Well, we sold the pizzas, we delivered the food, so it's a legitimate revenue at that point, but we're not getting cash. We're going to get paid later. And accounts receivable is the T account that represents how much money all of your customers owe you at that point in time. This is how much customers owe us at this point. This is how much we owe to our suppliers at that point. It's easy to get mixed up, accounts receivable, accounts payable, if you go too quickly. Okay. So let's see here. We got some activity going, huh? We purchase supplies for cash. Purchase for supplies. This account really should be called prepaid supplies. We're not quite up to that. These supplies will last for several months, okay? Since they will be generating future benefits, the supply should be recorded as an asset. And this is called, we'll get into this in chapter 4, but bear with me right now. Those supplies is not an expense until you use them. Until then, it's an asset, okay? So we increase the asset called prepaid supplies, and we created, I forget, yeah, it was a cash payment, $80, okay? So you can see how these T accounts build up, okay? And what you're looking at is really what the general ledger kind of looks like. The general ledger is pretty much the same thing, except it'll have another pair of T accounts next to with the balances. Now, some of our customers are paying us. So there's no revenue involved in this. We already recorded the revenue when we delivered the food, right?
Mm-hmm.
So Mitch got paid that $2,400. Wow, somebody paid $1,900. He got the cash. This does not affect revenue. The revenue was recorded last month when it was earned. So what do we have here? Cash is going up.
Mm-hmm.
And what's happening to accounts receivable? Is that going up or down?
That's going down.
There you go. There you go. That's what I want to hear. Cash went up. Accounts receivable went down. And now customers only owe us $500. Oh, now they're sneaking a three-parter in on us, huh? We're purchasing an asset on account or credit, but we're also making a partial payment. So let's see, he bought another motor scooter for $1,000. So the motor scooter is an asset. That's going to go up 1,000, huh?
Mm-hmm.
He had to give the guy though $300 in cash. Where would the balance of $700 go?
Accounts payable.
Yeah. Let me know if these numbers get too small to see. I can make them bigger.
That's good.
Okay, because I'm running, it's my eyes are worried about.
Mm.
Okay, so here we go. He brought in another $1,000 worth of delivery equipment. So now he's got a total there of 10,300. He had to make a payment of $300. So cash goes down with the credit and accounts receivable goes up or down with the credit, Lori?
Accounts payable goes up.
Yeah, goes up with the credit because now we owe this guy $700. He paid insurance, a prepaid insurance account. So this is an asset. You buy an insurance policy in December and it covers you for the next year. In December, it's still an asset you own. So an asset goes up 700 and cash goes down 700. Okay. Like an eye chest, isn't it?
Yeah.
Okay. So here we go. Here's our new transaction. Prepaid insurance, it's just an exchange of assets. That's all it is. Uh-oh, we got to pay the payroll. Well, that's certainly an expense, and we're certainly going to pay them in cash, huh?
Mhm.
So we're going to debit wage expense and credit cash. Debit wage expense,
Mhm.
credit cash. Cash went down, this went up. Now here's the other side. This time we're the ones selling something and getting a down payment from somebody. So we sold $2,600, or how much? $3,500 worth of pizza. 900 came in cash, and the rest we billed out. We expect to get paid maybe in 30 days. Since the delivery fees have been earned, 3,500.
Mhm.
So let's see what we have here. We have 3,500 in revenue. Cash is 9. This would be 26. So take a look here. We're going to debit cash for 900,
Mhm.
debit accounts receivable of 26, and credit the delivery fees. So here's our debit to cash for 900. Debit accounts receivable 2,600. And of course, that's our revenue here. And what we're doing here, Lori, is these revenues add up, these expenses add up. The difference would be, of course, our profit at that point in time. Now, let me talk about the withdrawal. And after we get through chapter 4, I think, you'll never see this again, okay?
Okay.
But it's part, but we have to understand it, and it's a part of the real world. Most businesses in this country are small businesses, sole proprietorships, and withdrawals come in. My goofy brother-in-law back in New Jersey, he and his family have run a bunch of stores for years, like 3 generations. They've never borrowed money for anything, it seems. And I don't even think they do financial statements. But what and I said to Marty, I said, how do you pay yourself? He said, well, at the end of the week, we just empty the cash register. The point is that's drawing, okay? And if he was doing real financial business transactions, that's how we would record it. So Mitch withdrew, he withdrew $3,000 in cash to buy some textbooks and things. Cash withdrawals decrease the equity, Lori.
Mhm.
They decrease the equity and they decrease the cash. Because when you handed your boss that check for $3,000 for him to go to Las Vegas or whatever, he reduced what the company is worth. So our entry is going to be a debit to drawing and a credit to cash. So that's pretty easy, the credit to cash. Now I want to call your attention to something over here. You see the debit to drawing, Mitchell Williams?
Mhm.
This account here, owner's equity, that's a credit balance. Drawing is also an equity account, but it's an outlier in that it has a debit balance. And there's a few of those that we're going to talk about. It's called a contra account. A contra.
I've heard that term.
Without getting into too much detail, a contra account is always married to somebody. So our equity balance is 5,000, and now it went down to 2,000 because of this.
Mhm.
That's called the net equity. And we'll get into that. Okay, now it looks like that was the last transaction we have to do. Okay, so we've done this work all month. Now you come to work 8 o'clock in the morning on February 1st. It's time to get going preparing the financial statements, okay? First thing you're going to do is print out a trial balance. A trial balance. The only thing the trial balance does for us, Lori, is verify that the debits equal the credits, okay? It's not a report that goes out to anybody. It's a worksheet. No one in the history of investing has ever said, hey, I want to see your trial balance. It's just a meaningless thing. But you need it to get going, okay? And the debits must equal the credits. It's prepared periodically for that reason, determine that we're equal, proves the equation is good. A trial balance, not a formal statement. The only people who see it are the people in the accounting department. It's their tool. And the purpose of it is to start getting ready to prepare financial statements. The trial balance, Lori, has to be in the normal order: assets, liabilities, equity, revenue, expenses. Any business I've ever seen, and for the most part, I think it's a general rule. When you look at your chart of accounts, the assets will begin with 1. Cash would be maybe 100, accounts receivable maybe 101, etc. Liabilities always begin with 2, 3 for equity, 4 for revenues, 5 for expenses. I mean, it's not a hard and fast rule. Companies can, call them whatever they want. But that's a way of remembering they go in that proper order. Here it is. Look at that trial balance. Isn't that something?
Mm-hmm.
Well, we got cash of 470, huh? You see that number?
Mm-hmm.
Accounts receivable, and wow, all these numbers, huh? Where did we get these numbers, Lori?
From all of the entries that we did.
You are absolutely correct. What was the balance in cash at the end of the month?
$470.
3,100. You see that?
Yeah.
The balance in the revenues and all this stuff. Okay, so yeah, that's exactly where we got those numbers. Okay, so that looks nice. It's in order. It's a nice looking sheet of paper, but all it does is tell us that $14,900 in debits equals $14,900 in credits. Okay. So let's see how we're going to put this into the financial statements. What we're going to do in this chapter, chapter 3, is we're not going to worry about what's called adjusting journal entries. That'll be chapter 4. Okay.
Okay.
So here, we're done. You're the accounting, you're my boss. You came to me and you tell me I bless the financial statements. Okay. We're now ready to prepare the financial statements. Okay. And they're giving you some color coding here. Blue are the assets. Then comes the liabilities, and then equity, revenue. So we have to do the financial statements in the proper order. They cannot be done any other way. It's not possible. You have to first do the income statement, okay?
Mm-hmm.
Income statement. So let's take a look at your income statement. You start off with the name of the company, income statement. And you see where it says 4-month ended June 30th?
Mm-hmm.
And you see it says 4-month ended June 30th on the equity. Notice it does not say that on the balance sheet. And that's important. The reason is, Lori, on the balance sheet, you have a snapshot of what the balances were at that immediate point in time. So it's not an accumulative number like the sales and revenues are.
Mm-hmm.
You have revenues of 0 the first day, they can only go up. So that's why you're supposed to say for the month end or for the month of, and here you have to say as of or just June 30, okay? This is a video. This is a snapshot. So let's see what we have here. We have fees of 8,000, and then they itemized the expenses, and they got 8,000 in delivery fees minus 2,750. Their profit was 5,250. Pretty good, huh?
Not bad.
Now, let me show you how we got those numbers. You see where it says delivery fees, Lori?
Mm-hmm.
I'm going to be telling all you guys, everything above your first revenue line is balance sheet. Everything below is income statement.
Okay.
So I would get in the habit of drawing a horizontal line right after drawing.
Mm-hmm.
And then everything below is the income statement. Well, look at this, 8,000 minus 1. There it is. So pretty good with that part of it, Lori? Okay. Now that we have the net income, we can now update the equity. The business has obviously grown by 5,250, right?
Mm-hmm.
That business is worth more. It's worth 5,250 more than it was earlier. So let's go to our statement of equity. And don't get rattled by this. This to me is an easy one, but students get nervous about it. I'll take you through it. What the heck happened there? Hold on. Why did my screen go blank? Hold on. Okay, can you see it again, Lori? Okay. If you don't mind, I'm going to make it a little bigger if I can.
Sure.
Okay, I can't do it. All right. I hope you can read those numbers. 8,000. So there is our net income. Now we go to the equity statement. And this equity statement is really just 4 lines. 4 lines. So let's take a look at it. He had no business, he had no beginning balance. I mean, he started this business with $5,000, right? Okay. He started the business with 5,000. So that's your beginning balance. Beginning plus net income of 5,250. Remember that? That's where we got it right here. But he also took 3,000 out of the business. So at the end of the day, his business grew from 5,000 to 7,250. Here's another little acronym if you want to list it vertically. BIDE, B-I-D-E. B-I-D-E, BIDE. You know, bide your time, right?
Mm-hmm.
Beginning equity, B means beginning equity, plus income, minus drawing, equals ending equity.
Mm-hmm.
And that's basically the whole statement. Sometimes they gild the lily a little bit. Like here, they didn't have to put a 0 up here and then show us the 5,000 coming in. I mean, that could have been the beginning right there, 5,000, right? So there's your beginning. There's your I, income, your D, drawing, and there's your ending balance, okay?
Okay.
Not too tough at this point, I hope. At this point in time now, we have done the income statement, the equity statement. So now we're ready to do the balance sheet, okay? Balance sheet. Now, remember I told you everything above delivery fees is the balance sheet?
Mm-hmm.
Well, here it is. All you do is copy every single number except one. What's the one number you don't copy because you updated it?
The drawing or the capital.
There you go. Great answer. Exactly right. You're not going to show the drawing on the financial statements. That's the owner's business.
Mm-hmm.
Although I bet if investors knew the boss took $1 million out for drawing, they might be interested in that, but that's not the point. Okay. So where do we get these numbers? We just copied them, 470. And look at this. We got 1,900 in payables. Congratulations. We just did the financial statements for this company. Admittedly, a small, simple format.
Mm-hmm.
Okay. So let's see what else we have here. Let's see what else we got. That's the end of our presentation, Lori.
All right.
I got nothing else in terms of slides.
Okay.
Anything you'd like me to look at again here? Any questions?
No, I think it's all making sense. I just need to get the whole debit credit really sealed in my brain, and the rest of it is, yeah, I think I'm good.
Okay, Laura, I'm glad you were here. My act always plays better if I have at least one person in the audience.
Well, I should always be here, so you'll at least have me.
That sounds good. And you know where to find me for tutoring whenever you need help, okay?
Perfect.
Okay, you take care, Lori. Thanks so much. Bye-bye.
Thank you. Have a good day.
You too.
Bye.